CIO Union Mutual Fund. I would not take much more of time. Whatever I say about Professor Damodaran will be less. So I would request Mr. G. Pradeep Kumar to formally introduce the professor and Vinay sir to the audience. Over to you, sir.
Thank you, Mr. Ghosh. Good evening, everyone. Of course, this is probably not the usual way of spending a Friday evening in India or anywhere. But then this is not a usual evening anyway. We have some very interesting stuff scheduled and some outstanding personalities with us. So first of all, I would like to thank Mr. Ghosh and the entire ICC for organizing this and giving us the opportunity to be associated with this event. So thank you for that. Okay. Ladies and gentlemen, let me first introduce our chief guest for this evening. It's somebody who really needs no introduction to any student of finance. Okay, and in the world of contemporary finance, he is one of the finest minds, popularly known as the Dean of Valuation, an authority on corporate finance, investments, portfolio management, and valuation. Widely considered to be a guru on these topics, someone who has authored at least a dozen books on these topics, and undoubtedly one of the finest minds, as I said, in the world of finance today. We are very fortunate to have with us Professor Ashwath Damodaran, professor at Stern School of Business at the New York University. Welcome, Professor Damodaran, to this session, and thank you for being with us.
Thank you for having me. I mean, I'm not sure how much of a fine mind I am. I mean, I'm a dabbler. I'm not a researcher. I'm a teacher, not a professor, but I'm glad to be here. So I'm fair game. I mean, the one thing I can promise you is whatever you ask me, I'll tell you what I think. It might not be the most diplomatic answer you could expect, but I'm too old to care what other people think about me. So we're off to the races. Thank you.
Thank you. Thank you. And, that's absolutely the way we would like it to be, because there are enough people that we keep seeing every day who give all the diplomatic answers. So we would really welcome something which is not really diplomatic. And talking to Professor Damodaran today, interestingly, is one of his most devoted disciples, I can say. My friend and colleague, Vinay Pahadia, who is the Chief Investment Officer at Union Asset Management Company. Vinay has about 20 years experience in fund management and equity research, and heads the entire investment function at Union Asset Management Company. And not only that, he's a student of Professor Damodaran. Fortunately for the hundreds of thousands of our investors and for our company, Vinay actually manages to put in practice a number of things that Professor Damodaran actually teaches. So when this opportunity came our way, I knew that this is something that Vinay wouldn't want to miss, and it's something that a lot of us have been really looking forward to. So without taking too much time, I would now hand it over to Vinay and Professor Damodaran to take it forward. Over to you, Vinay.
Thank you, Pradeep. Thank you, ICC. And a warm welcome to Professor. Thank you, sir, for giving your valuable time to us. So, sir, I would start off straight away with the most popular discussion nowadays, which is the low or negative interest rates which are prevailing in the economies today. How do we deal with this low interest rates while dealing with them in valuation models?
Now, the first thing we have to recognize in financial markets is everything is connected to everything else. There are no exogenous inputs. What I mean by that is there's no God out there setting interest rates. Much as we give power to central bankers as being the setter of rates, I've described the Fed chair in particular as the Wizard of Oz. And for those of you who are not familiar with the analogy or the movie, in the Wizard of Oz, the truth is the wizard has no powers. His power comes from the perception that he has power. And that's the thing to remember about central banks. Central banks might give you the illusion that they set rates. But if you think about it, the only rate that a central bank sets, in the US, for instance, the only rate the Fed sets, it's a Fed funds rate. The Fed funds rate is the rate at which banks borrow overnight from the Fed. It doesn't set T-bill rates, it doesn't set T-bond rates. So much as we'd like to think low interest rates were given to us by the Fed, they're a reflection of underlying fundamentals. In particular, one of my favorite equations in economics, and I'm not an economist, is the Fischer Equation. Fischer Equation basically says you can break interest rates down to expected inflation and an expected real interest rate. Or as I prefer to think about it, it's inflation and real growth. And here's the reason it gives you the basis for understanding rates. If inflation is high and real growth is high, interest rates will be high, no matter what the central bank wants. If inflation is low and real growth is low, interest rates will be low. So if we're thinking about interest rates being low as a good thing, and many investors seem to think that, it's a mixed blessing. It's a mixed blessing because it's true that it brings down the rate of return we demand in investments, and by doing so pushes up value. But it also brings with it signals about future growth and inflation that should be built into your valuation. What gets people into trouble when they deal with low interest rates is they use numbers that reflect the economies of the past when it comes to growth and cash flows, and they use today's interest rates. And if you do that, you're mismatching. You're mismatching because you're building in an interest rate level that is reflective of low inflation and real low growth, but you're putting in high growth into your numbers because that's what you remember from the past. And the older you are, the more danger you're in. And the reason I say the older you are, the more danger you're in. One of the things we know from behavioral finance is the importance of framing, which is we have numbers in our head, whether we like it or not, that frame how we think about things. So for instance, you'll hear people talking about a normal interest rate. What the heck is a normal interest rate? You know what a normal interest rate is? The normal interest rate is the interest rate you used to see when you were 30 to 35 years old. Which means if you're 30 to 35 right now, you know what looks normal to you? 2% rates, 1.5% rates. If you're 65 years old, God help you. Because when you were 30 to 35, the rates you saw were much, much higher. So I think we need to be careful with low interest rates to be consistent. I have never found low interest rates to be an unmixed blessing. My valuations with lower rates reflect the lower growth that I expect those low rates to bring. So I think low rates have changed the way we should be thinking about stocks, but it does bring this problem, which is trusting historic norms on things like PE ratios is going to get you into trouble. I mean, even somebody with a Nobel Prize, and I'm talking about Robert Shiller, fell into this trap, right? Because he came up with a normal PE ratio based on looking at US stocks from 1871 to whenever, 2010, 20. And he said, well, PE ratios look high. And what he was failing to factor in is PE ratios should be much higher in a low interest rate environment. So to me, low interest rates are neither here nor there. They change your numbers, but they don't really change your value dramatically if you're internally consistent. You talked about negative interest rates. You know why negative interest rates freak us out? Because we've never seen them in our classrooms, right?
Correct.
When you take an econ class, nobody talks about let the interest rate be minus 5%. So the first thing you got to get over that mental block of this can't be true. How can rates be negative? And here's a simple explanation for why they can become negative. Remember I said low inflation begets low interest rates, high inflation creates high interest rates. Could you have deflation? Absolutely. If you're in a deflationary environment where real growth looking forward is negative. Why? Because your population is aging. Japan, Europe. Why are you surprised that the euro risk-free rate is negative? Why are you surprised that the Japanese yen risk-free rate is negative? And if you think of that as a good sign, you're missing the big picture. This is not a good sign. This is a reflection of a very stark future where there's deflation and negative growth. So I think we all have to, I tell people this in my class all the time until they get tired of it. I say, you got to live in the world you're in, not the world you wished you were in. And the world we're in is a world of low interest rates, and everything we do in investing is going to be framed by those low interest rates.
Right. So one of the things which you mentioned is the power of central bankers. It seems that some of these low interest rates are pushed by the central bankers, or it seems that they have made all of us to believe that they are controlling the interest rates. So what do you think about that? Is that a fair thing to think about? Central bank?
I think that's what central bankers might want you to believe. And a lot of investors want to believe as well. It's nice to be able to say the central banks can keep rates at 1% while inflation goes to 5%. Because then you get the best of both worlds, right? You get high inflation helping you in your growth and cash flows, and the bank will take care of it. I don't know what world those people live in, but it's not the world that I live in. If inflation, somebody's got to be buying these bonds, right? If inflation is expected to be 5%, what investor in his or her right mind, no matter what you think about the Fed, is going to be buying bonds with a 1% rate? Jerome Powell could come into my house, beg me to buy the bonds, and I'm not buying the bonds. So this notion that central banks can somehow keep rates low as growth and inflation comes back is delusional. And that delusion is held by a lot of investors because it allows them then to pay these high prices for companies expecting the Fed or whatever central bank you're in to keep rates low while they push up growth and inflation into the cash flows.
So what could change or compel the central bankers to reverse their stance? For example, would it be in inflation going up dramatically, or?
Well, it's not central bankers who will get it. Investors have to wake up. Central bankers have nothing to lose. It's you and I as investors waking up and saying, oh my God, inflation is 6%. What the heck are we doing paying 2% for bonds? Those moments of awakening always happen in markets, sooner rather than later. I'm old enough to remember when inflation was double digits in the US in the late 70s. That's when I started looking at markets. I know how difficult it is to put the inflation monster or the inflation genie back into the bottle once it comes out. And I think people are being a little too casual, in my view, about the return of inflation. Because if it does come back, there is no easy way to find valuations that are consistent with that high inflation.
Maybe it's an entire generation who has not seen inflation, and it's only seen falling inflation and interest rates. But wouldn't you think that a lot of central bankers, like for example, Bank of Japan, they have been actually been in the stock market buying equities?
You know what the definition of insanity is? You keep doing the same thing over and over again, expecting a different outcome. The Japanese central bank is insane. It's insane. It's actually, who cares what Japanese central banks think anymore? This is the problem when you let rates go really low and people realize you have no control. The Japanese central bankers have no clothes on, and everybody knows. It's like the emperor's new clothes. They've been walking around naked, telling people they're wearing robes. For a while, we believed them, but nobody believes it anymore. The Japanese central banker has become an onlooker in this process, and that's deadly for a central bank when nobody cares what you think anymore.
What do you think ultimately will spoil the party?
Who knows, right? We never know how corrections happen. It's not one big event usually. It's a collection of small cuts. That's my experience. When market corrections happen, you can't point to them and say, that's what caused the 2001 dot-com crash. That's what caused the 1987 crash. It's just a collection of small things that don't make sense. Each one you explain away. Well, that's okay. That's okay. But you get to the 18th or the 20th small cut and you say, you know what? This has been happening much too often. So I think that's why it's so difficult to make money on corrections. Is if it were one big event, we could build a model that would predict when that event happens. We could get ahead of the game. I don't have the power to do it. That's why I'm not a market timer. Much as I'm worried about markets, I am not the kind of person who's going to step out of markets entirely saying, I'll come back when I'm ready, because I've seen what's happened to people who've done that in the US and Europe. They've been out of markets now for 10 years. And guess what? Even if the correction comes, they've lost so much money being out of the market that no correction could have hurt them as much.
Yeah, so you have been proponent of this karmic view of investing. And
I think the karmic view, come on, we're in India now. Might as well bring something Indian into investing. And the karmic view is actually a very healthy view. You control the things you can. You don't worry about the things you cannot. You make the best judgments, the best decisions you can with the information you have, and then let everything fall where it might. And the advantage of that view is it makes you humble. You recognize, you might never tell your clients this because they might not then invest with you, that so much is out of your control that you can do only the best you can with what you have under your control.
Right. So one of the things which I can summarize is that the way you deal with this negative interest rate or low interest rate is adjust your growth expectations, right?
Exactly. And I think bring in that reality. When I value European company, I bring in the reality that if your bulk of your revenues are in Europe, the future doesn't look good. I'm not talking about the next 3 months, the next 6 months. You can tell me all kinds of rosy stories about bouncing back from COVID. But long term, I've always believed that when you value a company, you're telling a story.
Right.
And a lot of companies in Japan and Europe, the story you're telling is a horror story. There is no happy ending. The basement awaits, and there's a guy with a chainsaw waiting for you down there. And I'm saying, okay, go down. No, you might take one step at a time and take 15 hours to get down there, or go down there in 15 seconds. Either way, once you get down there, the chainsaw is going to do its work and the story is going to be over. But there are lots of stories where this low interest rate phenomenon is going to be the death knell of the company. It's telling you bad things about its future.
Lots of horror stories.
Yep.
Right. So what we'll do is we'll change gears and talk something more about the core subject of valuation. So one of the things we have discovered while practicing valuations is that one of the key component in valuation is the beta of a company. And the beta of a company is never stable. It keeps changing. And it is a very critical component in valuation. So how do you judge the beta? And because that's very crucial in terms of your forecast for a value of a company.
I'm going to dissent on that. When I value a company, I don't think beta even makes my top 10 lists of things that I worry about. Let's face it, beta is a measure of relative risk. I tell people we attach Greek alphabets to things because we want to bulldoze people with pseudo-sophistication in finance. Beta is just a measure of relative risk. So when you say beta for a stock is 1.2, you're saying it's 1.2 times more risky than the average stock. The reason I say that I don't really spend too much time on betas, risk-free rates, risk premiums, cost of capital, much as it's written about it, is what the median cost of capital for a global company was last year? Do you want to guess? What is in US dollar terms? First, I have to be careful. It was 6%. 6% was the median cost of capital for a global company. You know what the 10th percentile, this is across 46,000 publicly traded companies. You know what the 10th percentile was? It was about 4%. The 90th percentile was 8%. Think about that. 80% of global companies have dollar cost of capital between 4 and 8%. You add about 3% to it, that'll give you a rupee cost of capital. So if you think in rupee terms, that basically means a median Indian company has a cost of capital of about 9%. A really low cost of capital for an Indian company in rupees would be about 6 to 7%. A really high will be about 11 to 12. And then think about how much time we spend, actually waste, finessing the cost of capital. Is your beta 1.12, 1.2? Pick a number, move on. Is this where you want to make your stance? And having said that, I'll also say that the betas for companies are not stable. The beta you get from a regression for a company is unstable. And the reason is nothing to do with finance. It's statistics. There's a standard error in your estimate. You're going to be all over the place. You're saying, what choice do I have? Only one company. Draw on the law of large numbers. I haven't valued a company with an individual company regression probably 30 years. And people push me. I don't give them a financial reason. I say, look, if you have a steel company, why would I want to bet that one steel company's regression gives me the beta for the company when I can use the average across 100 or 1,000 global steel companies? That beta doesn't move very much unless the entire steel business becomes riskier or safer over time, which can happen. That beta doesn't change. Right. So I take my blessings, small though they might be, and move on. And, rather than get bogged down on measuring risk and cost of debt and cost of equity, step back and think about the big picture. What are the numbers that matter? Sure. The key drivers of value are in your numerator, not your denominator.
Sure. So one more area which we have seen, which differentiates two types of or categories of companies is growth companies and or faster growing companies and slower growing companies. Especially when the rates are lower, would it be a fair statement to say that the duration of a stock would be a far bigger determinant of its relative valuation?
It will. It'll also make it riskier. So it cuts both ways. Absolutely. Basically, it's a pure time value issue. I mean, one of the starting points for every one of my classes is I draw what's called a financial balance sheet. I say, look, if you look at a company and break down its assets, I don't go the accounting route and look at fixed and financial. I'm not an accountant. I frankly couldn't care less whether I can look at an asset or not look at an asset. I break down assets into assets in place, investments you've already made, and growth assets, investments I expect you to make in the future. Rather than talk in the abstract, let's take two companies, ITC and Zomato. If I asked you where the bulk of ITC's value comes from, a Charminar cigar that, I don't know, when did they create it, is still the core of their value. 80, 85, 90% of the value is in assets in place, investments they've already made. If you ask me where Zomato's value is, even if I'm an incredible optimist on Zomato or a pessimist, let's face it, one thing we'll agree on, it's not Zomato's existing investments that create Zomato's value. It's what I think about Zomato's future. How many people use food delivery? Will it go into grocery delivery? The bulk of Zomato's value is way out in the future. Now, normally when your cash flows are way out in the future and you discount them, then if you have to wait 10 years, you're saying that's not worth as much. Think about the present value effect of having lower interest rates. Holding all else constant, the present value of the same growth 10 years out will be much higher with low interest rates and high interest rates, which means high growth companies in good times will have much higher values at low interest rate. But here's the catch. Would we say low interest rates are sending a signal of low growth, potentially economic trouble? If that economic trouble comes around, the same forces that push up the value of these growth companies when interest rates are low will come back and knock their values down disproportionately. This isn't an unmixed blessing. It is true that low interest rates are good for growth companies, but it's also true that low interest rates actually make growth companies more risky. More risky because that value is going to swing around. But I'll give you one other thing that I think that, especially with COVID around, has changed my perception of how I would invest in companies. One of the things we discovered in 2020 was not just this divide between growth companies and mature companies, but the divide between flexible companies and rigid companies. Rigid companies are set in their ways. They're not because their management is older and more rigid, but because of the business models. They have big infrastructure investments, so it's very difficult for them to change the way they do things. They borrow money, they pay big dividends. You've already locked yourself in on your investment policy, your financing policy, and your dividend policy. You're saying, so what? You get hit with a shock. COVID. Guess what? Your costs still are, you're stuck with everything you've done. You still have to make your debt payments. You still are kind of trying to pay the dividends because the shareholders punish you. You're still stuck with the big manufacturing. I think one of the messages I got from COVID is we're in the 21st century. The 21st century is a century where flexibility, I think, is going to be the core of any business model. And part of the reason for that is technology has muddled the game. It's made it much more difficult to kind of forecast what the world will look like 10 years from now. So why would I want to make a 50 or 100-year investment? Now, somebody was talking to me yesterday about, and this is a group that's actually working and trying to get more green energy investments in India. And they said people are unwilling to invest in green energy in India. They were convinced it's because the costs of capital people were using were too high. And I said, I don't think that's a reason. I said, would you want to invest in a 40-year or 50-year investment in India where you know that the technology could very well be the wrong technology? And if you add on top of that, the Indian government's predilection to change the rules of the game every 5, 10, 15 years, why would I want to invest for the next 40 years? So I think flexibility is the core word that I would be looking for in a business model. And that would mean that I don't look kindly on borrowing money, even though it might look cheap to you right now. Locking in dividend payments, even though that might get a few shareholders to buy your shares, because you're making your business model, your financial model, much more rigid by doing so.
Got it. So not growth or high growth or slow growth, but flexible or inflexible.
Exactly.
Companies.
I would take a mature company with flexibility over a growth company that's inflexible.
Got it. That's
because
a great
flexibility is what's going to give me, it's an optionality. Basically, they can change their minds.
Absolutely. Respond to the environment.
Mm-hmm.
One more thing which is being discussed by a lot of us is equity risk premium. What are your views on how the equity risk premium should be looked at, especially in this environment? Or
in any environment, it's a price of risk in equity markets. It's what equity investors demand as a compensation for taking risk in equities. And if you think about that definition, two things come out of it. One is it's going to be a function of how scared people are. Equity risk premium shot up between February 14th, 2020 and March 23rd of 2020. This was the first 6 weeks of the global economic shutdown. Why? Because people were terrified. So the first is equity risk premiums are not set by experts. They're not set by banks. They're not set by portfolio managers. They're set by demand and supply in markets, a reflection of the fear, the risk aversion that people bring in. But if you take that to the next level, then almost by definition, that number is going to be dynamic and changing. Why? Because think of the roller coaster ride each of us has been over the last year and a half, right? 1 week, things look good. The next week, everything's shut down. The third week, it looks like you don't have a job. The fourth. So as you've gone up and down, do you think your fear has ebbed and flowed? Absolutely. You know what that also means? Equity risk premiums have been on a roller coaster ride. In fact, in 2020, as some of you read my blog know, I computed the equity risk premium for the S&P 500 every single trading day for the year.
Right.
It's my temperature gauge. How scared is the market today? It's the most movement I've seen in that number in a 1 year, on a daily basis in a 1 year period, because I did this in 2008. And the difference in 2020 was astonishing. You saw the same kind of rise you saw in 2008 in the first 6 weeks, from February 14th to March 20th. But here was the difference. In 2008, the equity risk premiums went up and they stayed up for the next 3 years. In 2020, equity risk premiums went up for 6 weeks. By September of 2020, they were back to where they were pre-crisis. And to me, that is one of the big questions about 2020 is why did risk capital stay in the game? What was it about 2020 that led people to say this is different? Now, because it was different. That to me was the biggest thing that jumped out at me at 2020 is how quickly risk capital came back into the game. You had, VC money never left the game. IPOs continued. Things you would never expect to see in a crisis year continued in 2020. So equity risk premiums right now are at about levels that are pretty close to what they were for the last 50 years. That surprises people because what's pushing up stock prices, not that the equity risk premiums have become low, but because the risk-free rate has become low. I mean, we talked about how risk-free is. So right now, if you take the T-bond rate at 1.2%, you add 4.5%, which is roughly the equity risk premium, and it's pretty close to what it's been. 4.5 plus 1.2% means that I'm settling for a 5.7% expected return on a typical stock in US dollar terms, 5.7%. In the 1980s, if I'd gone to a portfolio manager, would you buy shares if I said you could make a 5.7% return? They'd have laughed at me. In the Indian context, Indian equities are now being priced to earn about 8 to 9%. Indian portfolio managers have been brought up with the notion that anything which is not double digits is not even a return. You know what? If you bring that perspective to these markets, nothing will look cheap to you.
Absolutely. Great. So now, since we are talking about the markets, one of the areas which we have observed is conflicting is the signals out of the US bond markets and the US equity markets. Aren't both these very, very conflicting?
I think there's a disconnect between the two. And for me, that's the most troubling part of this market. Because here's what the bond market is signaling: low inflation, low growth.
Absolutely.
Right. What's the equity market signaling? High growth, okay, even high inflation. One of these markets, and it's the same investors often investing
Absolutely.
in both markets at the same time. So you got Fidelity investing in the bond market, the equity market. It's almost like they have, how, these movies with split personalities. It's almost like you've got split personality investors.
Absolutely.
And one of these is going to be wrong. And either being wrong is not good for equity, is not good for stock prices. If the equity market is wrong and really the economy is not going to grow as people think it is, well, earnings growth is not going to be what you expect. You got to bring down the value of stocks. Now, if the bond market is wrong and inflation is going to be much higher, then we have a different problem, which is growth can come in, but our discount rates have to adjust up.
Absolutely.
So I tell people, look, we're in a disconnect between the two. And that's happened before. And whenever you've had a disconnect between the two, there's a moment of reckoning. I mean, I'll tell you, 2008 to me was a moment of reckoning where the bond market was charging this tiny price for risk in the form of default spreads. The equity market was charging much more. The ratio was at an all-time high. And it stayed there for about a year before the correction came. And then the bond market the default spread surged, and you had the correction in both stock and bonds. So I think that is troublesome to me. And it's not just, I think, US. I think you're seeing this play out across global markets. A bond market's telling a story that is very different about the future of the economy than what equity markets are saying.
Yeah, and no one knows what would be that trigger or moment of reckoning, which can change.
And I think that's again this karmic thing. You know that if there's a correction and you can't predict the correction, worrying about whether there's going to be a correction and when it will happen, what's that going to do for you other than give you an ulcer?
Absolutely. Absolutely. And as you have rightly said also, no one should call it a bubble or not, because
there's an air of contempt when you use the word bubble, right? Because when you use the word bubble, what are you saying about all those people who are buying? Those are crazy people. They're shallow people. They're not very, very bright people. And already you're setting yourself apart, right? I've read Ben Graham's security analysis. I go to Omaha every year. I listen to everything Warren Buffett says. And the minute you set yourself apart from the market as being better than the market, even Warren Buffett's discovered that he's not bigger than the market. The market is capable of bringing anybody down. And if you hold yourself up, it's almost like you're begging to be taken down.
Absolutely. Absolutely. That's a very, very important learning. So what would cause a sustainable rise in inflation? Because that could be one of the key triggers which can, or the moment.
Go back to your first econ class. Too much money, chasing too few goods. That's it. Everything else is a side story.
Which is
if governments and banks keep printing money, that's never ended well. I think for the moment, the excuse is this is COVID. That's why we have a 1.9 trillion, 1.5 trillion. We're talking trillions now. We're not even talking billions. And the
Right.
excuses were in unusual times, that excuse starts to become old after a while. I mean, in 2020, in the middle of 2020, you passed a bill that was $1 trillion and you said, we need it now. I got it. I understand there's excess capacity in the economy, you're filling it. You're doing this in 2021. You're pushing your credibility by saying, we're still in COVID. What about 2022? If governments and banks get used to doing this as their way of keeping the economy inflated, it's not a question of whether, it's a question of when. I mean, all that money has to find its place somewhere, and it's pure econ. Inflation is the outgrowth. I think what governments need to know is when to put their foot to the pedal. And 2020 was obviously time, but they also need to know when to take their foot off the pedal, which is, hey, you can't keep doing this. We can't be the crutch that keeps the economy looking good. We've got to let the economy find its way. The Fed, to give it credit, is finally struggling with that question now. You're hearing talk about,
Yes.
maybe, but they need to do something fast. And to be honest, I think good central bankers should be almost invisible.
Yeah. So
Speak less, act more. Don't be going out and giving speeches. We're in a time when central bankers have become celebrities, and that's not healthy for us.
don't you think that the monster of stagflation could also scare us because of these actions?
Yeah, because once inflation comes back, as I said, it's not in your control, right? That's the problem with inflation. I think people say, well, what if there's 4% inflation? That's okay. It's almost like they can say, oh, at 4%, I'll just put a cap on it. Inflation is not it's not a dog, a house pet that you keep around. It's like keeping a tiger on a leash.
Absolutely.
A tiger on a leash I don't care how good the leash is. You're not going to keep the tiger going where you want it to go. So that's the problem with inflation. 4% can become 6% and 8%. And you don't need very much before inflation eats into almost everything you have.
Yeah.
And I tell people, the only people who dismiss inflation are the people who've never lived through inflation. There's no more deadly mechanism in investing than inflation eating away at your returns.
And inflation hits the poor more than the rich.
Absolutely. And that's the other thing. People think inflation, the only people who are going to be affected, people who own stocks and bonds. You know who's affected? The guy whose paycheck doesn't keep up with inflation anymore.
Absolutely.
No.
Absolutely.
So I think inflation hurts if you're wealthy, you might find another place to put your money, real estate, gold, whatever you want to do. If you don't have wealth and all you depend on is that paycheck you get every month, I've never read a story with a happy ending for a country with high inflation.
Absolutely. Just few more questions since we are talking about India. Have you looked at Indian markets, or what do you think about valuations? A lot of people would want to know.
As I said, I dabble. I look at things that interest me. In fact, right now I'm working on blog posts looking at Chinese tech, Tencent, Alibaba, Didi, Pinduoduo. And why I'm looking at it, right? Because for a decade, Chinese tech has been the success story. Right. Alibaba is $600 billion, Tencent $600 billion. They're the two largest market cap companies in China. And the reason for their success has always been that they're going after disruption in a huge market. It's big market squared. And people have therefore given them these high prices. But with every Chinese company, anybody with good sense has always known that Beijing is always at the table with you. So if you're having dinner and you think your shareholders, Beijing is sitting at the table with you. It's both a plus and a minus. Let's face it. Baidu is a successful company because Google is not allowed in China. Didi was able to buy out Uber because Uber realized very quickly they went head to head with Didi in the Chinese market. There was no way they would succeed. It's almost every company, Beijing has been a helper. And investors have therefore priced that helping in. But in the last year and a half, we've discovered that Beijing likes growth, but it values control even more. And it's worried about these tech companies getting out of control. And of course, you've seen it play out in each of these companies being brought to heel by Beijing saying, you think you're a great company, you still have to do our bidding. So what I'm talking about is the effect of government and value, which actually is relevant in India as well. Government is always a partner, good or bad, in every venture you take. And I think that I want to map out an evaluation. How do you bring in that government effect, good as well as bad? Because every single input, there is an influence of government. I mean, it's true in every part of the world. The difference, though, is that government influence is the key driver of your value. Then, in a sense, you shouldn't even be analyzing the company. You should be a political analyst, because everything depends on who the government is, what they plan to do. So I know. So my point is, when I look at that, I'll probably draw extensions to the portion of the Indian market that is more heavily affected by government licensing and policy. Because my objective when I value companies now is not so much to get a value just for that company, but to draw lessons that I can apply to a much broader cross-section. So my interest in Indian markets ebbs and flows. If something interesting is, with the reason I looked at Zomato and probably I look at Paytm, is because I'm interested. And I want to see how the story plays out, because I can see the attraction of the story, but I want to see how I convert that story into numbers and evaluation. So sometime in the next couple of weeks, I'll probably look at Paytm and take my cut at it. But fintech is always a tricky place to be. It's much more difficult than doing a food delivery business, but no, absolutely, I think it's worth looking at.
But you have been doing this for quite a while, right? That before a company announces its IPO price, a week before that, you put out your estimate.
I try to do it as soon as the prospectus comes out, before the bankers start throwing numbers at you, because I've discovered once you hear a number, whether you like it or not, it kind of burrows its way into your brain, and before you know it, your valuation kind of gets drawn to that number.
Great. Yeah. Thank you, sir. I think we have gone through most of our questions and answers. I will stop here and now hand over to the ICC for any questions from the audience. Over to you, sir.
It was wonderful, really wonderful. I could have sat mesmerized. The questions are too many questions. I mean, what
you want to start? You want to start with crypto? I see a lot of crypto stuff coming through here, which tells me something about your audience. Must be a lot of 25 to 35-year-olds in the audience. So,
yes, sir.
Millennial gold.
Let's start with Bitcoin, right? Now, I've been tracking Bitcoin from the very beginning, and I've described Bitcoin as currency created by the paranoid for the paranoid. And I don't mean that as an insult. It is the reflection of the truth on Bitcoin. And I'll tell you why I call it a currency created by the paranoid for the paranoid. You know, Bitcoin, the paper that created the Bitcoin idea from Satoshi Nakamoto, who was, of course, a pseudonym for that fat guy in Cleveland in the basement, maybe, was November 2008. That was when the paper was written. I don't know how many of you were in the market November of 2008, but I remember November of 2008. We were a month and a half into the worst crisis hitting global financial markets and the global economy since the Great Depression. And people had lost a lot of money, but more critically, they'd lost all faith. Faith in governments, faith in central banks, faith in bankers, faith in CEOs. Bitcoin was born in that moment where you trusted no one. And its design reflects it, right? If you think about why Bitcoin is constructed the way it is, remember that birthday, November 2008. It'll tell you why when you use Bitcoin to buy something, you need 1,000 Ukrainian miners running 100 computers to figure out if they have the Bitcoin in your wallet, because it's designed so that you don't need a central bank, you don't have any trusted authority, you basically I'll give you the analogy. When you want to order food at a restaurant, how do you check out which restaurant order food from? In the old days, you'd go read restaurant reviews, right? Today, you know how we pick restaurants? We go on Yelp or whatever restaurant, website you use, and you look for other people who've rated the restaurant. How do you decide which books to buy on Amazon? You look at the stars next to the book. You have 4.5 stars. It must be a good book. Decide what movies to watch. You go on Rotten Tomatoes and you see what the audience score is, not what the New York Times thinks. We've trusted crowds and everything else. Why should Bitcoin be any different? But I think it reflects that loss, that absence of trust. But that's its Achilles heel, because it creates a very inefficient currency. Over the last 12 years, I've seen people say, well, Bitcoin's here, Overstock is accepting it, Microsoft is accepting it, El Salvador is going to go to Bitcoin 12 to 13 years after its creation. You know how many transactions are actually done in Bitcoin? I mean, transactions as in buying houses, buying cars, buying books. It's minuscule, minuscule. And the reason is not because people haven't heard of Bitcoin. Everybody's heard of Bitcoin. It's because it's a very inefficient currency. So let me give you my optimistic view of cryptos and digital currencies. You can create a really good digital currency, but you need an element of trust. You might not have a central banker, but you need somebody you can trust so you can create more efficiency. Because the essence of a currency is it has to be stable. Right? I mean, if you have a currency and it moves around 30% in a day, you're never going to see transactions in it, because people will not buy with it because they're afraid of how much they will lose. And people will not accept it as payment because they don't know how much it'll move. So the problem with Bitcoin in particular is that it is not a very good currency. And it's not behaved like a very good collectible. So if your argument for Bitcoin is, I'm holding it for the same reasons my parents used to hold gold, gold has 4,000 years of history to back itself up. People have held it through every fiasco, every crisis, and after the crisis, it still holds its value. Bitcoin has not behaved like a collectible. A good collectible holds its value when financial assets are melting down. Take a look at what Bitcoin did in 2020. And if you're holding Bitcoin as a collectible, it should terrify you. So my big picture perspective is, and separate blockchain from Bitcoin. Blockchain is a technology you can use independent of cryptos, right? You can do a blockchain in US dollars, a blockchain in Indian rupees, a blockchain in Ethereum. So blockchain is an innovation. I think people overstate its criticality, but I understand why people are excited about blockchain. Bitcoin, on the other hand, I'm kind of meh on.
This question is a lot of questions on cost of equity valuation of startup companies. If you can elaborate on your concept of the dark side of valuation.
Remember I said my discount rate is not even in my top 10 list of worries with a company. With a startup company, it's not even on my top 100 list. And I value Zomato. And you can disagree with my valuations. You know how much time I spent on the discount rate? Like 2 minutes at the end. I just picked the 10%. I actually picked, I said, look, pick a 90th percentile, make it a risky company, give it a high cost of capital. Let's move on. Because this is not where you're going to make or break your valuation. It's what you assume about the Indian food delivery market, the market share that Zomato is going to have of that market, the revenue slice they're going to keep. These are the big questions that drive Zomato's valuation, not its discount rate. The D in the DCF should never be 80%, 70%, or even 15% of your time. Get it done, move on. You know why we obsess so much about the D? Because by putting the third decimal point on the cost of equity, we think we're in control. It gives us this illusion of precision. So with a startup, especially young companies, just use a high discount rate. And we know what's high or low because we have the histogram. That's why I do that histogram at the start of every year, is I'm not going to waste my time trying to figure out what Paytm's cost of equity is with the beta and a risk-free rate and a risk premium. I'm just going to give it a high cost of equity relative to other Indian companies, which is about 10 to 11%. And then I'm going to go back and spend my time on where I think my valuation is going to be made, which is what's a business model? What are they going after? What's the total market? What will their profitability look like? What will they have to reinvest? Focus on business questions, not on discount rate questions.
One question is, sir, could we show government policies influence driving force our discount rate arc or to show in annual cash flow itself?
You know what I was saying about discount rates, it pisses people off, but I'm going to say it again. Don't make the discount rate the receptacle for all of your hopes and fears. I've seen analysts do it too often. What I mean by that is people who sit for the discount rate say, you know what, I think that the regulations could change. So let me push up the discount rate from 9 to 11%. So, oh, the management is getting old. Let me push the discount rate from 11 to 12.5%. My ulcer's acting up. Let me push it up from 12.5 to 14%. So the discount rate just becomes this mechanism that you move around till you say, okay, now I feel comfortable. That's not what it was meant to do. So if you have worries about government regulations, guess where they need to show up? In your margins, in your cash flows, in your growth rate, in the numerator. Over and over again, I emphasize to people, if you have concerns about a company, if you love a company, if you hate the management, you love the management, the place to show it is in your earnings and cash flows, not in your discount rate. It was not. Discount rates are blunt mechanisms. They're very difficult to adjust for all of these other factors. And once you start bringing in arbitrary factors, God help you. Might as well abandon discounted cash flow valuation and go to pricing. Use a PE ratio, move on. You're not going to be there. At least then you're being honest. You're not playing games with the discount rate to come up with the value you want to see.
Now I would like, there are more questions. I would like to invite Dr. Dean on the Director Studies of Institute of Cost Management Accountants of India. He wanted to ask a couple of questions to you, sir.
Sure.
Dr.
Absolutely.
Nondi, Dr. Nondi?
Yes. I'm audible?
Yes, sir.
Yes.
Am I audible?
Yes,
Yes.
you're audible, but
So,
not.
sir, this is a great privilege to be associated with your program tonight from the Institute of Cost Accountants of India. Sir, I have a very basic question to you.
Yeah.
Sir, being a cost and management accounting body, our institute, sir, what is your advice how the professional accountants like cost and management accountants, we call us as a CMA, can explore our professional career
in valuation or in accounting?
Share a very basic question. Yeah.
You're not going to like my
Yes, sir.
answer. You know what? The accounting mindset is singularly wrong or singularly unsuited for valuation. Because think about it. What are accountants focused on? Precision, making sure your balance sheet's balanced. It's all about, precision, accuracy, and recording what's happened. And let's face it, without you doing it, I can't do valuation. So I'm eternally grateful for accountants for giving me the raw data. But I wish they'd go away after that. The problem I have with accounting as I see it is accounting is coming into my turf. You know what I'm talking about, right? This notion of fair value accounting, of trying to come up with values for intangibles. Just let it go. Give me the raw data, which is what accountants do very well. But if you're an accountant and you want to go into valuation, you have to recognize that you've got to almost abandon a lifetime of training. And there are two, when I look at accounting, I'd see two things. One is you're historians, you record the past. And the second is you're rule-driven. You know what I mean by rule-driven, right? Take a look at GAAP, take a look at IFRS, take a look at the Indian accounting rules. You can't do this, you can't do this, don't even think about doing it. It's a set of rules. Accountants create rules to deal with problems. In valuation, you've got to be forward-looking, not backward-looking. And you've got to be principle-driven, not rule-driven. So my advice to accountants who want to make a career switch is you almost have to make a personality switch as well. So all those skills that made you a chartered accountant are the skills you got to set to the side when you do valuation, Because in valuation, you got to make leaps of faith into the future. You sometimes, and almost every single time, you can't dot the I's, you can't cross the T's, you can't get the precision you'd like to get. And you got to be okay being wrong 100% of the time. It's got nothing to do with theory. It's basically got to do with, you have to be okay being wrong. And accountants have a really difficult time being wrong because they've spent a lifetime trying to be right.
Sir, next question, Mr. Nandi. Or I can ask one question on behalf of the audience.
Sure.
Question is, can you, sir, would you please explain the difference in the different role by country risk premium while valuing a domestic company and in case of a foreign company? And also,
let me ask you a question. Is Infosys a domestic company? Is Tata Consulting Services a domestic? This notion of domestic company based on where its headquarters building is Coca-Cola, a domestic company. The way I describe much of the world now is we live in a world of multinationals, which through the accident of history happen to be incorporated and traded in India, China. Now, the reality is I'm going to bring the same rules to valuation in valuing Infosys as I do in valuing Coca-Cola, which is your risk doesn't come from where you're incorporated and traded. They come from where you do business. So when you think about country risk, don't think about where your company is incorporated, traded, domestic or foreign companies. Think about where you get your revenues. Because that's where risk comes from, is where you operate.
Another question, what is the difference between credit risk premium and equity risk premium?
Credit risk is what you charge if you lend to a company. Equity risk premium is what you charge for buying its equities. So if you're a bank making loans to a company, a Nigerian company, you got to bring in a credit risk premium because you worry about not making interest payments, not being paid your principal. If you're buying PZ Cousins Nigeria, which is a Nigerian equity, then you got to think about country risk premiums and equity risk premiums. And because equities are riskier than bonds, equity risk premiums, well, country risk premiums, at least from an equity perspective, are going to be larger than what you see in the default spread.
Mr. Pradeep Kumar, sir, would you like to ask anything?
One of the thank you. One of the big concerns that many people in India have, and I have, being in the asset management business, is the effect of the ultra low interest rates that's having on the behavior of people who live on income, the fixed income products. Mm-hmm. We have started noticing this trend where people are moving towards riskier products in the chase for yield. In your experience, have you seen this before, and how does it really play out? Because
I think yeah, and it's good. I mean, I think you're right. I mean, if you're 65, 70, 75, you spent a lifetime saving what you thought was enough money to be retired, because when you were growing up, a fixed deposit in a bank was delivering 11, 12%. Remember, fixed deposit rates in India were double-digit numbers not that long ago. It wasn't like you got to be 150 years old to remember them. So you save money on that expectation, you get to retire, and then you put your money in the bank and you're discovering you're making 2% or 4%. You said, this isn't enough. Of course, you're going to go searching for a higher yield, which means you're going to be prime target for every scam out there. Because if I'm promising you 12% guaranteed in this market, I'm lying. I'm lying. There's no way you can do that. There is no conceivable way you can guarantee a 12% return. You can tell me you'll make 12%, but then you're playing games with my money, and I shouldn't be surprised to see things blow up. And it's not just older investors. I'm seeing companies do the same thing. I mean, this isn't, I think we very easily consign short-sightedness and stupidity to the small retail investor. You know what? It's a collective problem. I've seen professional, I've seen mutual fund managers who've been in the business 30 years chasing yield. You know how they do it? in a slightly more sophisticated way. They go for stocks that pay 6% dividend yields. You know, the only companies that pay 6% dividend yields in this market are companies on the verge of blowing up. The search, so the search for high yield doesn't surprise me, but it does mean we're opening ourselves up when that correction comes, or when that scam blows up, that you're going to get a lot of pain. But here's my worry. When you get a lot of pain, what do governments do? They feel sorry for you. Poor you. Let me hold your hand. I know this sounds brutal, but sometimes people have to be allowed to live with the consequence of the mistakes. I know it's a brutal thing to say. I'm not, and especially with people who should know better, when they go out and they do things that they know, they're letting their greed overwhelm their common sense. I think we need to let them fail and deal with the consequences, because we step in and bail them out. We're just setting ourselves up to repeat this process over and over again. But I agree with you. We live in dangerous times, especially for people who need that fixed income yield, and there's nothing out there. I think they are going into more and more dangerous places looking for that yield, and some of them are going to face the consequences. And I think that partly explains why you see this rush towards crypto trading, because many people buying Bitcoin. If you ask them why are you buying Bitcoin, it's not because they think Bitcoin is the future, but because they think they can flip it to somebody else in a couple of weeks or a couple of months and make 15, 20, 25%, which is fine. You're a trader, but be honest with yourself. This has nothing to do with investing. You're trying to, in a sense, gamble your way to a more significant wealth position.
One last question, if you may permit, sir. It's
Sure.
The effect of corporate governance on the valuation. How to go about it?
If you own shares in Reliance, don't operate under the delusion that that you have any input anywhere in this process. So let's face it. In the investment family group companies, you are, in a sense, you're a capital provider. You're not a shareholder in the traditional sense. There's nothing wrong with that, as long as you don't delude yourselves. So I think, do I care about corporate governance? Yes, but I care more in badly managed companies than well-managed ones. But here's the problem. Even if a company is well-managed, and I think Reliance is a well-managed company, I think the analogy I would give is the analogy between a democracy and a dictatorship. In fact, if I asked you, would you like a benevolent dictator or a typical messy democracy? A lot of people in today's world would probably say, I'll take a benevolent dictator. I want somebody like Lee Kuan Yew, and look at what he did at Singapore. I'll wager there are a lot of Indians, a lot of Americans, a lot of Europeans would say, I'll take a benevolent dictator. The only thing with benevolent dictators is they can turn malevolent on you. So you can have a company where the existing CEO and management is doing a great job. You buy shares in the company knowing fully well that you have no say in how it's going to be run. And I'm not just going to pick on Indian companies. You buy shares in Facebook. Let's face it, you have zero input. Why? Because you're voting and non-voting shares. Be very clear about what you've just done, which is, you bought shares, the company's well-managed and well-run. For the moment, you're sitting pretty. But what if 10 years, 7 years, 5 years from now, the company's management turns bad on you? That's when you're going to miss the absence of shareholder power. So you miss corporate governance when you need it the most, but it's often too late because you bought the shares when the management was good, the company was good, and said, who cares that I have no control in this company? I know that's why I would say care about corporate governance when you still have a chance, because by the time you're desperate, it's too late.
Thank you, sir. There's still plenty more questions, but we have exceeded our time, sir. And so with this, I would like to say pranam to you and say a formal thanks on behalf of the Indian Chamber to you, Mr. Vinay Pahadia, and to Mr. G. Pradeep Kumar, sir.
Thank you.
Thank you very
Thank
much.
you.
for this
Thank you,
wonderful-
everybody. It was a pleasure.
Thank you.
Thank you, sir.
Take care.
Okay, sir, I'm ending, sir.
I'm going to check off. So.
Okay.
Okay.